The best investing advice I ever got came from a millionaire I looked up to as a kid. I asked him, "How do I pick the right stocks?" He smiled and said, "Treat it like finding a girlfriend." At first, I laughed, but now I realize it's the perfect analogy. When you buy a stock, you're not just trading. You're entering a partnership. You're trusting this company to grow with you, so make it one that's loyal, stable, and long-term. Define your strategy. Just like dating, you need a game plan. Are you chasing short flings or looking for something serious? In investing, that's the difference between technical analysis for short-term traders using charts to catch patterns, high risk, fast moves, but 95% of day traders lose money. Fundamental analysis for long-term investors. You're looking under the hood. Company health, leadership, reputation, the stuff that actually matters. You're not gambling. You're building wealth with purpose. Check the balance sheet. Think of a company's balance sheet like their dating profile. It's their financial bio. Assets, debts, and equity all in one snapshot. Let's use Coca-Cola as an example. Open up Trading 212 or Yahoo Finance in the US. Go to Coca-Cola Financials Balance Sheet. You'll see current assets like cash, inventory are the cookies on top of the jar. Long-term assets like equipment, real estate, cookies deeper down. Intangibles, brand value, patents, the flavor you can't see. Then the liabilities, basically the cookies they owe their friends. Quick check. Total current assets divided by total current liabilities. If it's over 1, the company can handle its short-term debt. Coca-Cola, about 1.13 solid. Check the income statement. Would you date someone with a messy financial past? Same goes for companies. The income statement shows how much a company earns and spends over time. Total revenue equals all income. Net income equals what's left after expenses. Let's crunch Coca-Cola's numbers. Revenue, $45.75 billion. Operating income, $11.78 billion. Operating margin equals 11.78 divided by 45.75 times 100, approximately 25.7%. Anything over 20% is a strong margin. Rule of thumb, 5% equals low, 10% equals healthy, 20% plus equals elite. But keep in mind, not every great company is instantly profitable. Amazon proved that. Track the cash flow. A company can look profitable but still bleed cash. That's why you need to check the cash flow statement, where the money really moves. It has 3 parts: operating activities, day-to-day cash flow, investing activities, assets bought, sold, financing activities, debt, dividends, and raising money. Red flags, huge negative operating cash flow, too much borrowing, paying high dividends without the cash to back it up. Coca-Cola passes here, strong cash flow, generous but sustainable dividends. Do qualitative research. Not everything shows up on a spreadsheet. Ask yourself, is the brand trusted? Are the customers loyal? Is the leadership competent and stable? Do they have any unfair advantages, moats? Example, Apple versus Xiaomi. Apple wins on brand trust in most Western markets, and that reduces risk. Also, CEOs matter. One bad tweet can nuke a stock. Just ask Lockheed Martin after Trump's 2016 tweet. So, choose your captains wisely. Don't panic with the news. Bad news spreads faster than facts. Think Facebook 2018. Cambridge Analytica scandal made the stock drop 18%. Years later, the stock have gone up over 200%. Long-term investors held because they did the homework. Only sell if you need the money for emergencies. You've hit a financial goal. You no longer believe in the company's future. Otherwise, zoom out. Stay calm. Understand stock types. You've got value stocks, slow, stable, pays dividends, great for safety. Growth stocks, fast-growing, volatile, reinvest profits. Examples, value, Berkshire, Hathaway, P&G, JP Morgan Growth, Amazon, NVI, DIA, Tesla, Meta. Check the PE ratio. Average 20 to 25 low equals value, high equals growth. Diversify. Don't marry your first date. Same with stocks. General guidelines: no more than 5% in one stock, no more than 20% in one sector, at least 25 stocks, 5 sectors, 2 countries. Still too much? If researching 25 plus companies sounds exhausting, there's a shortcut: index funds. VOO, VTI, or S&P 500 ETF give you instant diversification. I've made over $17,000 a week with this strategy, and I explain how in the next video, but don't click just yet. Subscribe if you want to grow your wealth. Drop a comment. I'm in if you're ready to invest long term. Watch this next to build your passive wealth the smart way. I'll see you over there.